The ability to transit goods and people easily along a well-structured trade corridor with no delays or hindrances at traditional pinch points is an idealistic vision, and establishing effective trade corridors in Africa has been the subject of much discussion in recent years. We've got Craig Polkinghorne, Global Head of Structured Trade and Commodity Finance at Standard Bank, and then Suresh Chaitu, Sector Director of Banks and Financial Development Institutions at RMB, joining us for some more insight into how you're approaching at both the two banks, the trade finance on the continent. Craig, I'll start off with you. Let's just talk about the trade gap, trade finance gap, because globally it's pinpointed at around $1.6 trillion. Much of that is rested with the problems in Africa right now, where Africa is facing a bit of a deficit. Is this tied into the fact that banks globally, European banks, are facing capital restrictions? I mean, what are the key themes when you're looking at the global banking system and its ability to provide this trade finance for Africa?
So I think good morning, Sam, and thanks for having us on the show. I think there are a number of issues at play, particularly in Africa. So after the 2008 global crisis, many banks reviewed what their capital and liquidity requirements were, and as a consequence of restrictions in both of those areas, restricted what their strategic ambitions were in different regions. And as a consequence, many pulled back out of Africa. By way of example, many of the French banks were particularly active in energy finance and also soft commodity finance, and a lot of those pulled back from Africa. So that has left a gap. Many of the regional banks are picking that up. So the South African banks have stepped up in terms of what they do across Africa for trade finance, and that's largely Anglophone Africa, not Francophone. And the French banks have come back. And then we're seeing new players enter in the form of some of the Indian and Chinese banks are starting to participate in African transactions. And we're also seeing the emergence of trade finance funds to fill that gap. So I think at the moment there is a deficit, there is a gap, but there are moves afoot to try and fulfill and supplement what finance is available.
Now, according to reports, both Standard Bank and FirstRand on the continent are leading the way when it comes to trade finance. I mean, what is the FirstRand Group's approach right now? Of course, representing RMB, but what is the group's approach right now when it comes to getting exposure to trade finance and playing in that space?
Sam, I think trade finance is a very, very strategic and important business focus for us in Africa. Trade finance really dominates the African space when it comes to predominantly all banks operating on the continent. And I think this is largely predicated by, one, the growing intra-regional trade flows between countries. I think borders are opening up and we're starting to see a substantial amount of intra-regional trade flows between countries. Second, I think there's been quite a bit of growth in these particular economies and a growth of a middle-class market, which again facilitates a lot of more imports into that country. We're also seeing growth in terms of the exports, particularly out of East Africa into various countries. And I think all of this augurs for increased trade flows, which banks obviously would facilitate on an ongoing basis.
Are you being more selective, though, in your criteria when you evaluate whether to finance a project or not?
Sam, I think it's important to realize that, when you're looking at particular trade finance, there are two angles to trade finance. One is looking at corporates and importers and exporters, but also looking at how much of bank risk is actually intermediated in those particular flows. So when it comes to bank risk, I think, Craig has mentioned it before, but I think both all the banks who are regional banks are operating and growing the amount of trade portfolios in terms of intra-regional trade risk. But more importantly, we're also starting to see big growth out of India, out of China from an export propensity perspective, which means there are a lot of more opportunities in Africa for us to look at structured trade and commodity financing.
So
Sam, could I make a comment there, please? I think the basic tenet of trade finance is that it's self-securing and self-liquidating. And what that means, by self-securing, it means you have inventory or stock that provides security for the loan, so that if something goes wrong, you can go and sell whatever that commodity might be. And the self-securing part means that the financier has a good understanding on who's going to repay that loan. And if you apply those, doesn't matter how complicated or how big the transaction might be, those basic principles still apply. So I think all the banks are still applying those same age-old principles. They want to see what secures the transaction, and they want to see what's going to liquidate the transaction.
That being said, have you ever been involved in a deal where you have been stuck with inventory you can't sell? Something that, oh, well, that was nice to have that, secured as collateral essentially, but now you're stuck with it.
We have, and I think one of the pleasing factors in that in that transaction was the transaction went bad, but the fact was that the stock still provided security for the loan, and we were able to get out of the loan satisfactorily.
Mm-hmm. So it's building in those risk mitigating factors. I mean, any experience when it comes to, being stuck with inventory or deals, trade finance deals that have gone haywire?
No, absolutely. But I think I think the point that Craig made is very important. Trade finance is regarded as fairly lower risk, and this is attested by the fact that if you speak to someone like the IFC, which has been integrally involved in supporting banks over the last 10 or 15 years in Africa, their risk or their default risk has probably been minuscule. 0.001% is what the last time they've quoted, over around $10 to $15 billion worth of trade flows. So you can see it's a substantial amount of a lower risk product, as Craig said. But as banks, yes, we are in the business of taking risks, and you do have some particular trade finance transactions that go bad. But when you look at it as an overall portfolio, Sam, it's quite low risk.
And the real challenge for us collectively as South African banks or African banks is that agricultural production is currently forecast or agricultural production in Africa is in the region of $320 billion currently, and by 2030 they expect that to be at $1 trillion. So that's 3 times bigger than it currently is. So the logical reasons why that's going to happen, in terms of food security, population growth, etc. But the challenge for the banks is how do you finance that growth? And certainly all the African banks, that South African, East African, West African, doesn't matter where they are all going to have to get themselves aligned to the fact that there's going to be an explosion in agricultural production.
What are going to be the biggest challenges when it comes to that explosion right now in terms of making sure that you mitigate against the risks?
Well, I think the big challenge for that to happen is infrastructure. So before we get the explosion in agriculture, we're going to have to sort out many of Africa's infrastructural problems. But as those get mitigated and sorted out, we'll be able to mitigate the risks, because the logistics chain or the supply chain from an inland production area to a port will be that much more efficient.
Yeah, I mean, let's talk about agriculture. How much of the trade finance taking place at RMB is specifically focused on the agricultural space? And is it a slightly more risky area? I mean, I just think about logistics. Food is perishable. So you need to make sure that it's properly in a container. You've got the warehouses, you've got the right kind of structures around it to make sure that it just, stays okay.
Absolutely correct, Sam. I think commodity finance is a key area of our business. We have a large, FirstRand RMB has a large commodity financing area. Most importantly, these commodities, as you said, are perishable, but more importantly, there's a lot of labor and logistics around looking after that commodities through security agents, through collateral managers, etc. Because these commodity transactions are a little bit more riskier than traditional finance, trade finance, simply because those goods not only are perishable but can also move quite quickly. So you have to have total and control over that particular commodity in order to protect your interest in that trade financing transactions.
But you're still lending to that space.
Absolutely, I think it's a necessary space to be in as a regional bank. But more importantly, Sam, if you're just looking at the amount of intra-regional flows, would you believe that Africa is at 12% of intra-regional flows is one of the lowest in the world? And I think there's so much of opportunity for banks, for countries rather, to open up their borders, that commodity finance and trade financing is becoming an increasingly lucrative opportunity in Africa.